Credit cards are a trillion-dollar industry. In 2018, they were swiped nearly 45 billion times, paying for products and services worth just under $4 trillion. Americans owe around $1.1 trillion in credit card debt, about $5,700 each.
The U.S. consumer is doing very, very well. Strong consumer sentiment, strong retail spending, very low unemployment. All of those things are great for the credit card industry.
Giants like MasterCard, Visa, and Amex dominate the network market. Chase, Citi, Amex, and Capital One are the biggest issuers. A quiet but a steady and perhaps lesser talked about competitor is Discover.
We're not one of those companies that's always out there talking about how great we are. The number one performing stock of all financials in the S&P for a 10-year period is not just an average company.
Discover has the 10th largest credit card portfolio in the world, despite a smaller footprint outside of the US. Still, there are 57 million Discover cards out there.
It's not really for the kind of people that want to fly first class to the Maldives. Discover really is kind of for the masses.
When you think about the average consumer and likely where they borrow and what their FICO scores are, I think that they're right smack in the middle of all these issuers.
The Discover credit cards topped the J.D. Power Customer Satisfaction Survey in 2019. So, how did they win over the American middle class? To understand the credit card industry, it's important to know the difference between a credit card network and an issuer. The network is basically the digital rails on which transactions are processed. A card issuer is the company who actually takes on the credit risk. Discover and American Express are both an issuer and a network.
That gives them some diversity in their business model. It also gives them a really stable source of revenue, at least from the processing side. Very different from the credit side of the equation, where that could be a lot more profitable if they're charging you 18, 20, 25% interest, but there's also risk there. And it's also less predictable in terms of the transactors and the revolvers. You know, people who are paying their bills in full or people who carry debt from month to month.
40% of Americans are transactors. 60% carry debt from month to month. We spoke with Discover CEO Roger Hochschild over the phone.
Our model is lend focused. We're looking for people, and we make most of our money from people who borrow money. American Express's model is much more spend focused.
For issuers, American Express and JP Morgan interchange the top two slots on outstanding debt. Citibank, Bank of America, and Capital One fill up slots 3 to 5. Discover is 6th. The Discover credit card was launched in 1986 by Sears Roebuck, the largest retailer at the time.
Back then, it was part of Dean Witter, which was part of Sears. And they launched during Super Bowl 20. They had this commercial back in early 1986.
This is the dawn of Discover.
They talked about the dawn of Discover, and they really pioneered two main categories: cash back and no annual fee.
Sears wanted to expand into financial services and decided to accept only the Sears Discover card at its stores.
Many merchants actually viewed them as a threat, and they thought that accepting a Discover card meant they were helping their rival Sears. So that actually really led to a lot of hesitation and difficulty for Discover establishing itself.
In 1993, Dean Witter Discover & Company became a publicly traded company when it spun off from Sears. Sears eventually filed for bankruptcy in 2018, but that's another story. In 1997, Dean Witter Discover & Company merged with Morgan Stanley. The mid-2000s were eventful for Discover, and the barrier to entry didn't end at Sears' front door. MasterCard and Visa were established in the industry, and Discover wanted in. In 2004, the Supreme Court upheld a ruling in Discover's favor. Discover claimed that MasterCard and Visa had harmed its business by preventing their member banks from issuing credit cards from the Discover network.
They did everything they could, including reaching out to merchants to tell them that taking Discover would help Sears.
After the Supreme Court ruling, Discover's business started taking off. GE Consumer Finance, Walmart, and Sam's Club became card clients. and Pulse, a debit card network, was acquired. With more than 50 million cardholders, the company had become a major player. In July 2007, only 6 months before the Great Recession, Discover severed ties with Morgan Stanley and started trading on the New York Stock Exchange as DFS.
We just set up our finance department, our treasury function. Luckily, we had a heritage that goes all the way back to Sears of being conservative lenders.
In the midst of the downturn, the company received welcoming news. Visa and MasterCard paid Discover nearly $3 billion in damages after finally settling the lawsuit. Discover's strategy remains simple: charge no annual fee, offer simple rewards like cashback, conduct all business online, 24/7 US-based customer service, and acquire and keep the customers who will revolve a balance every month.
There's a relentless focus here at Discover on a limited set of businesses. You compare us to most other banks that are big in credit cards. They've got commercial real estate, they have small business lending. We're focused on consumers.
That consumer is a prime borrower. 81% of Discover's customers have a FICO score of 660 and above. Competitors like American Express caters to a more affluent customer base with a higher average FICO score. And Capital One serves a larger number of subprime borrowers than Discover.
We might be more like Toyota, and American Express may be more like Mercedes.
I would say the typical Discover customer is probably a little bit more likely to be middle class or even lower middle class, maybe more likely to be a parent, maybe more likely to live in middle America. You know, we're not necessarily talking about the affluent urban professionals that are more likely to gravitate to, let's say, an Amex card or a Chase card.
According to the J.D. Power Customer Satisfaction Survey, Discover has been voted number 1 every year since 2014, except for in 2017.
It's very difficult in this stage of the game in the United States, in a very mature market, to grow your business because so many people already have a card. But it's doing a really, really good job of keeping the customers it has very satisfied with the value proposition that it's offering.
I think sometimes these airline mile cards get a lot more attention because that's just a sexier kind of redemption, right? It's, you know, first class, airport lounge, all that fancy stuff. The fact is, though, we found that about 2/3 of credit card rewards chasers prefer cash back.
Discover's balance sheet reflects the company's improving finances since the 2008 recession.
The investors that are here are looking for, high capital return, and they've been roughly around that 70% plus payout to investors through dividends, share repurchases. And so it's about having a high ROTCE, having a very, stable but growing business model.
Maybe it's the Midwest heritage. We're not one of those companies that's always out there talking about how great we are. And there are others who do much more of that.
But the last few years haven't stacked up for the Discover stock. In a 1-year and a 5-year comparison, it underperformed that of the S&P 500 and multiple competitors. On January 24, 2020, a day after the company's earnings call, the stock fell by 11%, the most it had done in 10 years. It was announced that their share of high-risk customers, something called troubled debt restructurings, increased by nearly 50%, something that has worried investors. In an email to CNBC, the Discover CEO, Roger Hochschild, said, "The market and individual stock prices can be volatile from time to time. Our focus is on continuing to build the long-term value of the Discover franchise, which we believe will be reflected in the stock's valuation over time." Data show that younger generations aren't as enthused about credit cards, and though people as a whole spend more and more on credit cards, revolving debt has declined nearly every year in the past 2 decades, potentially hurting companies like Discover, who depend on finance charges.
If you want to continue to talk to your shareholders and give them a successful story, you're going to have to come up with something that's going to look better than just steady as it goes. It would not be surprising if in time we see Discover either making an acquisition through merger with another credit card issuer or being acquired by somebody bigger.
In this day and age, it's hard to know what's going to happen, but I would say we have a complete business model. We're strong on both sides of the balance sheet. If you think about our lending products, but also our deposit products. So I feel very good about how Discover is positioned.